Well, hi, everyone. Welcome to today's program. My name is Peter Lenardin. I'm the Strategic Account Manager at Communitech. I'd just like to welcome everyone to the webinar today. We've got an exciting agenda ahead of us. We've got designing tax-efficient compensation arrangements with our friends from Ernst & Young here. So I guess what I'll do to just get started, I'll just turn it over to Amir and Lawrence to quickly introduce themselves, and then we'll get into the program.
Sounds great. Very much. Yep, sounds great. Thank you very much, Peter. Hi, everyone. Welcome. My name is Amir Abdullah, a partner here at EY. I practice in the tax group. I've been practicing in tax for a number of years. My area of specialty is really tax planning for Canadian individuals, Canadian corporations, and high net worth individuals and their families. And so I cover a wide variety of things, but really focusing on tax planning. So Lawrence, over to yourself.
Hi. So my name is Lawrence Levine. I'm a lawyer by training. I've been working in the area of executive compensation for a while. It's like almost 20 years. I'm designing various kinds of executive compensation plans, stock option plans, and dealing with the related issues. So very happy to be here today.
Great, fantastic. So I'm just going to share your presentation. Okay. Sorry about that. Okay.
Excellent.
How did you want to start?
All right. So if are we ready to go and take off from here, Peter, or is there anything?
I think so.
Okay.
Can everyone see the slide?
Yeah.
Okay, great.
Okay, great. Lawrence, over to you.
Great. Thanks very much, guys. So as I noted in the introduction, I practice in the area of employee and executive compensation. So when I go to cocktail parties or those types of events, and people find out what I'm doing, they always have a lot of questions, right? And usually the common question is, so tell me, what is the best compensation plan that is out there? Right? So being a lawyer, as I noted, I always respond with a typical lawyer response saying, well, it depends. So what I thought we could do in the next 30 minutes or so is maybe talk about some of the it depends factors, right? And these are things to think about in terms of designing your compensation plan. So what we'll talk about are the different types of compensation alternatives. The main, at a high level, the main differences are share-based compensation or cash-based compensation and different types of plans. What are some of the benefits and drawbacks of each? And then what we'll do is we'll talk about the tax consequences of various arrangements, because tax is sort of what we spend our days doing. And then also what I thought I would do at the end of, if time permits, is talk about some other topics, and that's sort of like frequently encountered issues that we see in the area of executive compensation, like so things that some companies are doing at the moment, or traps that I've seen various clients fall into over the years. And maybe if one person could avoid one pitfall, then I would consider this all worthwhile. Okay, so maybe starting from the beginning, when a client comes to me and wants to talk compensation, really the starting point should always be, well, what do you want to get out of this plan, right? So what do you want the compensation plan to achieve? Because the type of outcome you're looking for would dictate the types of plan which is most suitable for your organization. Now, most clients will say, well, we're looking to retain top talent. We're looking to attract, employees who may be looking at, much bigger organizations. So we need to have something, enticing enough, to attract these types of people. Or they may also say, well, we're looking to incent a certain type of behavior. We want to encourage more, entrepreneurial activity. We're trying to, encourage employees to, for example, grow sales or do something. So, I mean, suffice to say, the objectives are that's the starting point. Because once we look at the objectives, then we can try and think of a type of plan to which satisfies it. So maybe what we can do, we can go to the next slide, and what we could do is just talk at a very high level as to some of the main compensation alternatives that sort of startups or companies which are a little bit beyond the startup phase may typically consider at this stage in their life cycle. So as noted, right, very broadly speaking, there are two types of compensation arrangements. There's arrangements whereby the employee could get shares, right? Those are things like stock option plans or restricted share plans. And then there's also cash-based plans, and otherwise referred to as phantom plans. Phantom meaning that it's not real equity, but maybe the quantum of the payment is linked to the value of the share or something like that. So before we get into tax, I mean, it's useful to talk about the business rationales for various types of plans. So stock option plans, very, very popular choice amongst startup type businesses. And really the rationale for it is when you have employees, particularly your first key hires, and you're a startup, typically the employees are buying into the dream, right? And when they're buying into the dream, they usually want to have a piece of the the spoils, right? So if the business does very well, and that's what we all want, they want to have some sort of ability to share in that good fortune, right? And when we talk about stock option plans, what we typically refer to are stock options with a fair market value exercise price. So those are options where the employee has to pay an extra, like a purchase price of the shares equal to the value of the share at the time of grant. So the employee is only essentially getting value to the extent that there's an increase in value beyond the time of grant. And so this is usually appealing to founders because there's a sense of alignment, and employees only get paid if there's a they only get value to the extent there's an increase. So the idea is that the employees are going to really try and work hard to increase the value of the enterprise, right? And also the idea of share ownership in general is it can be quite good from a psychological perspective for employees, because there's usually most owners they come to me and say, well, I wish my employees would act like owners, right? Really go beyond sort of, and they don't want people who are just punching in and punching out. They want people who act like owners, who will go that extra mile. And when an employee actually has shares, right, then they are an owner, right? So that that can encourage more of that type of desired behavior. Now, of course, if you're granting options, the benefits are, as discussed, employees could become shareholders. There would be no cash outlay required. And in fact, if there's a fair market value exercise price, the company could get cash for the cash subscription price for the shares. But then there are downsides we've got to think about as well, right? So those downsides are things like the whole prospect of having new shareholders in the business. So depending on the capital structure, maybe there's just one owner manager, right? And so it could be a very big change to bring in employees. There's often concerns about when you take on new shareholders under the corporate statutes, shareholders have rights to certain information such as financial statements, And then so there sometimes there's a question about, well, do we want to share financial statements with employees, right? That's a concern of some. But a lot of other types of concerns like voting and things like that can be mitigated by creating a separate class of non-voting shares, which is often done. You know, having a shareholders agreement which already operates to limit the rights of shareholders. That's also you know, highly recommended. And also the idea of having you know, share plan can be a bit more complicated than sort of just a pure cash-based plan, because you know, there's a need for valuations, which can be difficult in the private company context where there isn't sort of a ready market for the shares. And then the biggest issue typically with these types of things is sort of what is the mechanism for exit, right? So, and this is particularly an issue with sort of younger employees. So, you know, it's great the employees are live getting the shares, but then they say, well, you know, the company's doing well, but they need the money. Maybe they have a young family, maybe they need to buy a house or something like that, and they want their money, right? And so they can often be an issue because, you know, there's no liquidity event, right? There's no third party, there's no public market for the shares. So it often can be difficult for employees to monetize. So then often what they'll do is they'll, you know, want to look to the founder and say, well, founder, will you buy back my shares? And that can sort of put the founder in a difficult position. So those are sort of things to consider. So you know, with respect to these alternatives or options, restricted shares, they are essentially the same type of thing as restricted share units. Sorry, that is the same type of thing as a stock option, except that instead of the employee paying a fair market value exercise price for options, the employee can get the share for free, right? And in both the case of an option plan and restricted share units, the awards are subject to what we refer to as vesting. So vesting are sort of things that the employee has to do in order to earn the award, so earn the ability to convert that RSU or option into shares. And so those are typically like service-based. So for example, a requirement that the employee remain employed for 1 year, 3 years or whatever, or sometimes performance conditions. So there may be performance conditions tied to, you know, the company achieving certain milestones, things like that. So you know, there's often a lot of work done around what are the appropriate vesting conditions. So those are the two, you know, very broadly speaking, those are the two main types of share-based compensation. A lot of private companies, though, decide, well, there's all this complexity associated with share-based compensation. You know, this whole idea we have to figure out a value for the shares, taking on additional shareholders when they may not already be shareholders. There's a lot of work, like corporate work in terms of authorizing the shares and so on. So a lot of, and then also, as I noted, the issue in terms of how do the employees monetize. So a lot of companies say, well, you know, it's too complicated, right? Too much risk. So we'll go with a cash-based plan, right? So a cash-based plan, otherwise known as phantom plans, you know, essentially give employees rights to, let's say, an annual bonus, right? Or a bonus over like a longer performance period. And so when there's a longer performance period, that's often referred to as a long-term incentive plan. LTI is also a term used. So the multi-year type plans, those would be things like payment over, like after 3 years based on performance over an extended period of time. A share appreciation rights plan, which pays employees, you know, says to the employee, notionally, you economically like a shareholder, but you don't actually have shares, but you'll get a portion of any increase in the value of the shares, right? So that's often what's done, and it's a way to say to the employees, well, you'll share in any increase in the value of the shares, but you're not actually a shareholder, and that dispenses with a lot of the issues around taking on additional shareholders, you know, getting rid of the shareholders, dealing with various types of issues where if the employee shareholder were to leave, you know, be terminated, those types of things. So those are sort of some of the major issues. If we can go to the next slide, what we can do is we can talk a bit about the tax consequences, which are and this is often like a driving factor behind the selection of the type of award. So what we have over here is, this is a little graph that we did for stock options to kind of graphically illustrate what would be the tax consequences. Now, we assuming that the types of organizations you guys are involved in are what's referred to as Canadian-controlled private corporations, right? So you probably are, but if you're not, I mean, that's something we could check. There are a lot of benefits associated with being a Canadian-controlled private corporation, in particular, in the case of employee stock options, there are benefits which we'll describe over here. So first off, where an employee has an enforceable right to receive a treasury immediately issued share of their employer corporation or company that's related to the employer corporation, there's no tax at the time that the option or RSU is granted. And there's also no tax at the time of vesting. So vesting in this context typically means that the option or RSU is being earned and won't be forfeited. At the time that the option or RSU is exercised, there would be an employment benefit. And the employment benefit is equal to the value of the share received less anything that the employee has to pay for the share, like the exercise price. Now, in the public company context or the situation where the company is not a Canadian-controlled private corporation, the tax would be due. There would be tax withholding required at the time of exercise, and then the employee would have to report the income in the tax return. However, in the case of where the company was a Canadian-controlled private corporation, at the time that the option was granted, then there's a deferral of tax from the time of exercise until the time that the employee disposed of the shares. Now, it's important to note that this deferral only applies to employees who are dealing at arm's length with the company. So if it's like an employee who owns more than 50%, for example, then that deferral is not available. Now, important to note that the employment benefit is crystallized at the time that the employee acquires the share, but tax is deferred until the time of sale. And that's sort of to recognize that there could be liquidity issues. It could be difficult to sell the shares to pay the tax, and that could be a hardship to the employees. Now, once the employee acquires the share, that any increase in value after that date would be a capital gain. And also, just I'll ask Amir maybe to talk in a minute about the capital gains exemption, but also at the time of exercise, in the case of fair market value options, where certain conditions are satisfied, namely that the option has to be sort of like a common share, and a bunch of other things have to be satisfied. As I noted, it's employment income, but the employee can get what's referred as a stock option deduction. Effectively, what it means is that the benefit they receive at the time of exercise can be taxed at capital gains like rates, which is a big benefit, because the top tax bracket in Ontario is 53.5%. So effectively, the employee could be taxed around 27%, big benefit. And then, in the case of the CCPC, that's deferred until the time of sale. Now, in the case also of the CCPC, there's an additional benefit with options, and that is if the options are held for at least 2 years, then there's also a 50% deduction on the benefit received on exercise. And that's significant because there isn't a requirement that the options be fair market value options or that these other conditions be satisfied. So there are ways that an employee could essentially get a share for nothing and only be taxed on 50% of that value, provided that the share is held for 2 years. And then once the shares is held, at that point, any increases in value after that time is a capital gain. And to make things even better, the employee could effectively benefit from the qualifying small business, the QSBC deduction, which Amir has a lot of experience. Amir, do you want to maybe say a few words about the QSBC deduction and
Sure.
where you see it coming up?
Yeah, absolutely. So we see it all the time when we have Canadian controlled private corporations or CCPCs, and they're startups or scale ups. And there has been an option plan, or the founders have shares, and there's a Series A, Series B, Series C, some sort of liquidity or exit event. And oftentimes people are looking to capitalize on exactly the things Lawrence has mentioned, like how do I get that 50% stock option deduction for myself and my employees for that first chunk of value that has appreciated between the grant date and the exercise date. Again, the chart I find is very handy because it drives, oh, sorry, if you go back, Peter, to the slide, I think it's slide 4, perfect. Yeah, we've got those dotted lines, that first tranche of value from, let's say, 125 to 250, that tranche is subject to income tax at employment rates. Can you get a 50% deduction for that? Yes. And then that second tranche from 250 to 300, that will be a capital gain. And that's the element where again, presumably you have a capital gain, again, taxed at about 27% in Ontario. You can use your lifetime capital gains exemption. Your lifetime capital gains exemption is, again, a lifetime amount. It's about $913,000 as of 2022. That number inflates up every year, and it will at some point in time get to $1 million, and that's when it'll stop inflating, and it'll just be the capital gains exemption is $1 million. And one of the things you can use your lifetime capital gains exemption on is a sale of qualified small business corporation shares, or QSBC shares. And very frequently, the criteria for QSBC, there's a number of them, but the real ones to discuss or talk about or highlight for this discussion is the employee has to have owned the shares for 2 years. So again, this 2-year thing keeps coming up in various different contexts, and it's very important because that's a policy decision based by our government to say, look, if you are going to get this benefit, we want to make sure you're an owner and you're in it for a reasonable period of time. And so the employee has to own the share. And so you'll see on the chart, the vertical slice between the exercise to sale, and that's the 2-year period hold time. It's not from the grant date to the sale date. It's just from the exercise to sale date. That period of time has to be 2 years. That's one of the conditions. The other condition is the company has to meet a number of criteria. One of them is it has to be a Canadian controlled private corporation, or CCPC, at the time of the transaction. And then over 90% of the company's assets have to be used in active business in Canada. And so those are the kind of 3 big ticket items that really matter to think about. Well, can I get lifetime capital gains exemption? Well, you gotta own the shares as the employee for 2 years, have to be a CCPC at the time of sale, and then at the time of the transaction, over 90% of the assets of the company have to be used in an active business in Canada. So again, we see this trip up if there are a lot of foreign owners of a company, and that sort of violates the CCPC test. And also we sometimes see this get tripped up if the company has scaled up to a point where they're actually a North American or a global company, and more than 10% of their assets are used outside of Canada. Again, they've got a US branch or a UK branch, or they've got assets all overseas, and that would then disqualify the company from being a QSBC, and therefore disqualify the employee from using their lifetime capital gains exemption. So that's my little blurb on QSBC. And again, it's only available for that capital gain portion. But as Lawrence mentioned, if you put all the things right and you sort of set the thing up appropriately, you can get a very appealing after-tax result for the participants.
Great, thanks, Amir. So Paul's got a question. I could maybe read it out. It says, can the employer issue the shares at whatever price they want, regardless of company value, i.e. sell 5% for $1, even though the company has $1 million in annual revenue? So I think, let me take that on. So I think the answer is the employer could sell the shares for whatever they want. But the issue is that if the employee receives the shares for less than fair market value, right? So like, let's say they're getting 5% for $1 million, and the 5% is actually worth 100,000. Then the employee would be considered to receive the benefit by virtue of employment equal to the difference of $99,999 would be an employment benefit. Now, in the case of a CCPC, that employment benefit should be deferred until the time that the shares are sold. But there would, so the short answer is you can do it, but then there would be, you know, a tax benefit to the employee. So I don't know, Paul, if that answers your question. And in the case of the CCPC, you would only have to pay the tax at sale. But if the company is, for example, not a CCPC, public company, then that tax would be due at the time the shares are acquired. All right, good. Can we go on to the next slide, please? Okay, so this one, all we wanted to do over here was just sort of illustrate the difference between RSUs and fair market value options. RSUs being a situation where the employee receives a share and doesn't have to pay anything for them. So what you'll see in this case, the employee is getting, you know, no tax at grant, no tax at vesting. At exercise, the employee is getting a share worth $250 and they're not paying anything for it. So the employee would have a $250 employment income inclusion, which, if the company is a Canadian-controlled private corporation, would only have to pay tax on it at the time that they sell the shares. And if those shares are held for 2 years, they could qualify for this 50% deduction on the employment benefit realized. And the same scenarios with the options, the increase in value from the time that the shares acquired, the $250 to the $300, that would be a capital gain and could also qualify for QSBC treatment if the conditions are met. One thing I actually just want to point out on this is there's often confusion. I'm sure you guys are not confused, but sometimes my clients are confused. So they speak to companies in the US, and in the US they issue RSUs, but they also issue a thing called restricted shares, right? And in the US it doesn't really matter that much because RSUs are taxed at the time that the employer acquires the shares, and RSUs are taxed at the time that the restrictions lapse. What an RSU is a promise to deliver the shares following vesting. But what a restricted share is the situation when the employee gets the share up front, right? And the share, they'd be entitled to dividends and voting rights as in the capacity of a shareholder, but they're not able to sell the share and can lose the share if they don't meet the vesting conditions. So in the US, it's just taxable at the time of the vesting conditions lapse. However, in Canada, the CRA's position is that restricted shares are taxable at the time of grant, right? Which is usually like not attractive, right? Because if the employee, for example, forfeits the RSUs because maybe they terminate employment or something like that, then they would only get a capital loss, and there's nothing they can do to reverse that employment income inclusion. So just something I wanted to point out, you know, if you're speaking to, you know, contacts in the US and they're talking about restricted shares, there are some situations where restricted shares can work, but generally speaking, it can be, you know, it can be a bit of a minefield in Canada because the employee is, you know, taxable upfront. Okay, so maybe we can go to the next slide. And what we did over there is we thought about kind of the situation of, you know, we're thinking about different types of compensation plans. You know, what are some things that you need to consider when you're setting up a new plan? So, you know, the first consideration really is, well, as we said in the beginning, like what are your objectives, right? And like, does this type of plan further those objectives or not, right? Then a question always is, well, who gets to participate? Right? Is it just going to be sort of the CEO? Is it going to be the top level executives, or like how far down the organization, you know, does participation go? One thing that's important to note is that you don't have to offer a plan to all employees in the organization. In fact, there could be very valid business reasons why you want to have different plans, right? So maybe different people in the organization can influence different things, right? So it's quite common to have, you know, certain plans for like the lower level staff, maybe cash-based plans which pay out sooner, and then sort of have maybe like stock-based plans for the executives who have more ability to influence the share price and who maybe don't have, you know, they can afford to wait until there's some sort of liquidity event, right? questions around, if you have a stock-based plan, like, is dilution going to be an issue, right? How much you're going to dilute other shareholders? Is it going to create a problem for like any investors that there may be in the business, right? And also the issues like how many shares are you gonna be willing to grant under the terms of the plan. So it's quite common in public companies for stock option plans to be capped at a maximum of 10% of the stock, right? The reason that is there's a stock exchange rule over there. In the private company context, it's sort of, it's not as clear, right? You theoretically could give away as much as you want, right? But typically, when you're designing a plan, you want to sort of decide sort of what the pool is and limit it to avoid excessive dilution. Point we kind of alluded to before was, like what's the value of the company, right? And this becomes particularly important if you're going to issue fair market value options, right? You need to know, well, what's the fair market value of the share? If you're going to buy back shares from employees, right? If you're going to be buying that back at fair market value, what is fair market value? And then also in terms of tax reporting, right? If you say, at the time that the employee acquires the share, that's when the benefit is crystallized. What is that benefit, right? So you need to know the value of the shares. Shareholders agreements. So like, if you're going to have share-based compensation, you want to have some sort of agreement which governs sort of foreseen and unforeseen events, right? So typically much easier to get employees or prospective shareholders to agree to the terms in advance, as opposed to kind of not saying anything, and then when there's some sort of conflict, trying to get them to agree at that point, then it's tough, right? So it's always a good idea to set out the rules of the game in advance, and those rules could go to sort of, drag along or tag along rights, or what happens, what happens if someone leaves, right? So what happens if someone leaves holding vested entitlements to shares or unvested entitlements, or has shares? What would happen in the event of a marriage breakdown? Are you prepared to tolerate shares going to like an ex-spouse or something like that, right? So these are always issues that come up, and most people feel quite strongly about. So it's always good practice to have a clear shareholders agreement. And then also things like how do you define an exit event, right? Often plans will say if there's sale of more than 50% of the shares or a certain amount of assets, that would be considered to be a change of control, and then certain things happen. So often you have vesting being accelerated, or things like that. But it doesn't have to be that case. And then always the question is, let's say the employee has their shares and they leave before there's some sort of exit event, before this investor comes in, or there's a sale, IPO, right? What happens to them, right? Do they get to continue to participate, or are their shares repurchased? Is there a mandatory repurchase? And if there is, like what do they, what do they receive? One point I actually just wanted to kind of highlight is around U.S. taxpayers. So this is something which comes up all the time. So the tax rules in the U.S. are quite different from Canada. And
when we say U.S. taxpayers, who do we mean?
Yeah, so that's what I was going to get to. So Canada taxes on the basis of residency, like say you're a resident of Canada, or if you earned income in Canada, right? But the U.S. taxes also on the base, not just on that basis, but also sort of on the basis of citizenship, right? So it's common in Canada to have U.S. citizens in Canada, or U.S. green card holders, and these people are subject to U.S. tax on their worldwide income, right? And there's a good chance that there may be some U.S. Taxpayers lurking in your organization. I've encountered many in my time, and the weird thing is they kind of look and sometimes sound very much like us. Maybe not like me, but Canadians. So anyway, that's the thing to consider, because if you do have U.S. taxpayers, the U.S. has got like quite complicated rules in the area of deferred compensation, and you need to think about whether you're subject to these rules or not. Because if you are, you need to think about whether like a separate plan needs to be designed for the US taxpayers, or whether it's possible to satisfy both the Canadian and US rules in one plan. So just something I'll throw out there because it seems to come up all the time. And just kind of also on the topic of sort of common issues, I would say in my time, I've found many situations with sort of startup companies where the startup, people are really focused on the business, but sometimes the legal formalities are neglected. So maybe they're not proper option agreements or RSU agreements. The shares may not be authorized, things like that. And, these things have the potential to cause a lot of problems down the line. Like for example, if you're saying there's an agreement at a certain date, but nothing was ever reduced to writing, the board didn't approve things. There can be issues, particularly where the share price has increased and you're trying to, argue that the options are fair market value options. So what I would say is, I know it's not sexy work, but the formalities and keeping good records, I mean, it is important, and documenting things in the minute book is important. And then just lastly, with COVID-19, there's been a big movement towards remote work, particularly in the high-tech space. There's a lot of my clients are allowing employees to work from different locations and all. And this does present a number of issues, right? The legal issues in terms of like employment law, immigration issues, corporate tax issues, which I'm sure Amir can speak to much more ably than me, potentially creating a permanent establishment, a taxable presence in another jurisdiction. And then, there's also like payroll reporting and withholding, which could apply in other jurisdictions too. So what I would say is if you have employees who are working in other jurisdictions and haven't looked at it, it's just something to keep in mind. And also if you're thinking about, having a, fully remote or having a arrangement where employees can essentially work from wherever they choose, that can, depending on the situation, carry with it some risk. So it's a good idea to kind of, think about whether the issues maybe craft a policy in that regard. Amir, I know we whipped through some of the stuff pretty fast, but was there anything you wanted to add?
I think for this section, a couple of things that I'd like to add is, all these are other considerations and things that Lawrence and I have come across the course of our practice and the course of our experience of things that clients have come to us or things that we have encountered that have been not oopses, but, oh, I really should have thought of that. We really wanted to bring this list of things to think about to this group, certainly as you are considering or developing or modifying your equity compensation plans or just your compensation plans in general, to at least put these forward so that you can think through them as well. Again, Lawrence has already mentioned two that aren't on the list that I think are good to keep in mind. Again, proper documentation. How are your minute books? How are your legal agreements? How are your employment agreements? Those are also important to have in place because Canada Revenue does come knocking. And when they do, it's best to have your paperwork and documentation in order to be able to support your position, because you take all this data and then it hits the rubber hits the road when you fill out the T4 forms or the payroll forms and do the withholding for your people. And so it's important, and it behooves you to have that paperwork in place, because really, if some of these things go sideways or wrong, you not only have an income tax problem from a corporate standpoint, but you have now a disgruntled employee, you have an HR problem, you have these other sorts of issues that you are beholden to resolve because it is your compensation plan that has been designed. So it does behoove you to talk about these. So that's the first one I wanted to talk about. And the other one is, where was it? Oh yeah, there are other mechanisms out there to generate or get shares in the hands of employees. And so again, there are ways that they can just come up with the money to buy the shares, or there can be loans from the company to buy shares, and those sorts of things exist, and just another tool in the toolkit that are available for folks to use and implement when, as Lauren mentioned, it matches your business and your goals and your organization's directives. I have a couple of questions for you, Lawrence, on our past slides, but I know these are our considerations for now. I'm keeping an eye on our clock, and I promise that we leave some time for questions at the end. And so I know Paul put a question in the chat, but I didn't want to monopolize the airtime in case there were other questions that people wanted to either come off mute and ask or put them in the chat. I'll encourage folks to do that now. Alternatively, as people get that going, Lawrence, I know one question that always comes up for me is, Peter, if we can go back a couple of slides to slide number 4, and Lawrence already alluded to this, is, you know, we all plan on this lovely upward trajectory of your share value, such that, you know, between grant investing, the price has gone up, exercise investing, the price has gone up again, and then the final exit and the exercise, the price has gone up again. And all of that lines up with our income tax rules. Again, you get an employment benefit for that middle tranche and then a capital gain for the top tranche. If for whatever reason that arrow is not a smooth straight line and it perhaps goes up and down over time, or even goes up and then goes down over time, you could end up in a situation where that first tranche is an employment benefits as employment income on someone's T4. But if the value of the share has gone down after exercise, well, that top tranche actually turns into a capital loss. And so on the way up, you've had employment income. On the way down, you have capital loss. And in Canada, you can't offset those gains and losses. They're actually deliberately pulled apart. And so again, you end up in a situation where, again, it's unfortunately by design of our income tax code that you have these two steps, that you have this problem of employment income on the way up, capital loss on the way down. But it does create, again, another HR or employee communication problem that, okay, sorry guys, this is the way it's going to be. I do have to put, $250 or the difference between 250 and 125, so $125 per share on your T4. Sorry guys, even if the share is only worth, $200 today. So it's one of those things to keep in mind, again, in the other considerations, that what if the value goes down?
Yeah, Amir, that's a really good point. I mean, I've been doing this long enough that, I've of course seen horror stories where, the value was high, the employee received share, and then, the value was low and they got a capital loss. And there've been some situations where, the value of this, the value of the shares didn't even cover the tax, right? Very unfortunate, right? That may be one reason why with fair market value options, you often see employees, essentially holding the options until there's some sort of liquidity event, right? So they don't actually pull the trigger until there's a liquidity event. It's kind of one of the purposes is to kind of guard against that potential risk that maybe they'll crystallize their gain at the time when the share price is high and then not be able to get out. Right? And that's why it's, with fair market value options, it's important to try and design the options so it meets it's like a good option from a tax perspective, so the employee can get the preferential treatment if the share is not held for at least 2 years. As noted, like having a fair market value exercise price and being sure that the share meets the requirements. That's a good point to know. One other thing I'll just note, because it has come up a fair amount recently because the markets have been a little tough. People always ask, well, they granted options at a time when let's say the exercise price was let's say $140, right? Now the share price is 80, right? So employees are saying, well, there's not much of an incentive, can we reprice the options, right? So the answer, and I'll leave it up to your discretion to decide whether or not to share this with the employees, is it is possible to reduce the exercise price of an option. But you need to be very careful how this is done. Effectively, what happens is you exchange the old out of the money options for new options, which are either out of the money or at the money. You can't put the options into the money because of the exchange, but you can exchange it to be at the money, right? Now, a lot of shareholders don't like this, right? Because the shareholders, of course, don't get to reprice. But they have, I mean, I have a number of clients who have done repricing because it was sort of considered, you know, a good move for their business. That maybe they were trying to retain certain employees who otherwise they were at risk of losing, or otherwise they would have had to come up with cash which they didn't have at the time. So know that alternative does exist, but you need to be very careful as to how you do the repricing. So just get professional help so that the repricing itself doesn't turn into a taxable event. And then also just one thing as I'm thinking through it, which also does come up, is sometimes there's a situation where employees get a fair market value option, and the employee's like, well, they don't have the money to pay the exercise price, right? Is there another mechanism that can use instead of to pay the exercise price? So there's this concept called net exercise. Effectively, what it is the employee effectively surrenders some of their options to the company, you know, to cover the exercise price, and they can exercise the options that are left over. So again, you know, if you're doing this, you need to be careful, especially in the Canadian controlled private corporation context, that you want to try and preserve this deferral and so on. So there is a way that you can do it which preserves the deferral and the good tax treatment and so on. And that way doesn't involve just sort of canceling some of the options, because the Canada Revenue Agency has said then that the whole thing is a cancellation of an option, which means tax is immediately payable and you have to withhold, right? So you don't want that. What you actually want to do is you want to do a exchange of options, and then have the employees exercise sort of these effectively what are like RSUs, like options with a zero exercise price. So they have given like 2 good tips.
Very handy.
So are there any other questions from the group? Feel free to just unmute yourself and ask. We're an intimate group today. So.
Yeah, guys, it's Paul here again.
Hello.
And so I just wanted to further clarify, like, so in our situation, you know, we've got, you know, we're going to have employee shareholders that, you know, fit exactly into what you guys are talking about. So I don't have any problem with that. But we do have a core group, let's say, that started at the very beginning. And so there was a, you know, verbal promise of, you know, X% of ownership to get going kind of thing. But we've never done the paperwork or the, you know, the appropriate stuff to show it physically in paper, because it costs money, right? And it's a startup, and, you know, we just never went and did it. So is there any way to kind of go, okay, at time of, you know, verbal assignment of these shares, value of the company was far lower than it is today, for example, if we did it?
Yeah, so this comes up, right? You know, so I can appreciate sort of a startup, and you have, you know, you don't want to really spend your money on legal fees. So look, I mean, that's an issue, right? Because, like, I guess the idea is that the employee, you know, would have gotten the shares at an earlier time, but now the share price has increased, but nothing was papered, right? Yeah, so I mean, it comes down to the specific facts, and in particular, you want to see, you know, how strong, like, when was the agreement created, right? Like, is there any documentation which says that maybe there was an agreement earlier, or like good verbal evidence that, you know, there's actually a case law which says that, like, a stock option agreement doesn't have to be in writing, like, provided that the evidence is strong enough. There was actually a case involving Bre-X. I don't know if anyone remembers Bre-X, but in that particular case, I don't know, it was the COO, CFO, one of those guys, went over to a secretary and said, well, I'm decided to award you 30,000 options. And then, of course, nothing was ever papered, least of their problems. But the court actually said that, you know, that was an enforceable agreement. So, you know, it kind of depends on the, you know, like what sort of evidence was there. I mean, if it just wasn't documented, you know, there could be some arguments. But then there are also sort of questions about whether the shares existed, and, you know, were the corporate actions taken, you know, and so on. So that's something which probably, warrants a bit of further investigation.
Yeah, I would say, Paul, from my perspective, you've got really the two options, and the one that Lawrence was describing was, can we document enough of a story to justify saying we had an agreement to issue shares to these people at this point in time, such that that point in time was, the company was worth $1. Or you have to go the other route of, well, since nothing was papered then, we don't have a sufficient set of paperwork or argument to document that scenario. We have to say, yep, you know what, we'll issue X number of shares today for $1. And you're in a situation where, again, presumably if you're a CCPC, you have an in the money option, and those have certain rules and regulations around when the tax is, the quantum of the tax, and determining if that's at least a serviceable solution for your employees and your founders.
All right, that's great. Thanks, guys.
Yeah.
Oh, we have a question here. Okay, so US employees. Yes. Okay, so the US, the rules can be quite different. In particular, there's this legislation, it's US Code 49A of the Internal Revenue Code, and what it essentially says, it's quite detailed, is that if you're subject to these rules, and you don't comply with them, then the employees could be taxable at the time of grant of the award, and then they're also subject to 20% federal excise tax, and some of the states have got penalties as well. So it's quite a bad thing. So for that reason, there's a lot of effort which is usually put into trying to ensure that the awards don't cause problems for the US employees. Now, fortunately, there are a number of exceptions to this 409A. So one of the exceptions is for fair market value options. So that is options with a fair market value exercise price. And just whatever I'm saying here, this is just very high level. Please, don't construe it as legal or tax advice. Just general information. So, so generally speaking, a fair market value option wouldn't be subject to 409A, so that's okay. But where you can get into trouble is if an employee has, doesn't have to pay anything to get the share, so an RSU, or the exercise price is below fair market value, or it's like a cash-based type of plan. Right? Those are all potential issues, right? So there you want to fit into one of the exceptions to 409A, or you want to comply. So there's a exception which is quite frequently used for RSUs. It's called the short-term deferral exception. Essentially what that means is that once the award vests, payment has to be made no later than March 15th of the following year. So if it's structured that way, then usually it's okay. And so that's a way that a lot of the US companies structure their RSUs and so on to fit into the short-term deferral. And then there are some other exceptions that apply as well, but the short-term deferral and the fair market value options are the most common. And if you don't satisfy any of those exceptions, then you actually have to comply with 409A. And 409A says that you can only have payments in certain events, right? Like fixed dates, termination of employment, stuff like that. So it's quite involved. So if you do have US taxpayers who participate in plans, it's a good idea to get it reviewed, because there's potential exposure on the US employee, and then the company is also supposed to be doing withholding and so on. So it's a good idea to look at these things. But the good news is that these rules have been around, I think, since they've been around for at least 10 years. So a number of solutions have been arrived at. So that's the good news, that in many cases you can kind of leverage work which was done before. So
Any other questions, comments, cries of anguish?
I just also put in the chat just before we wrap. If you'd like to kind of have a brief conversation, initial conversation to talk with our friends at EY about your tax and compensation issues, just please reach out to me. I've chatted my email there, and I can set up something for to have a quick talk. And yeah, are there any other questions before we wrap? Okay. Well, I'd just like to thank everybody for joining us, especially thanks to Amir and Lawrence for all your expertise. And I could see you wincing at a couple of those questions, and but it was great, great to have all that input. Well, thanks everybody, and look forward to seeing you at the next Community Tech AMA. Talk to you soon.
Great.
thanks
Thank you,
very much.
everyone. Have a great evening. Bye-bye.
Bye-bye.